go by Sacred Profit, and today is October 20th, 2025, and we'll go over the market news for the day. Now, you'd imagine on a day where the AWS servers suffered some problems, taking down access to a bunch of different apps, blockchains, lowered productivity across the world. Actually, it's not across the world. It's just for those who are on the East Coast server. But anyways, pretty substantial. You'd imagine that would be the dominant headlines. But we only care here what affects retail markets. And what affects retail markets today is Bitcoin. All right. So we're actually going to be touching on a few of the items here that surround the macro landscape. But you're going to see it ends with there seems to be this huge focus on Bitcoin for a number of different reasons. So let's start off with the Trump threats of tariffs of 155% tariffs on China if there's no deal signed by November 1st. So markets moved up pretty significantly today after the futures open on Sunday because it looked like the agreement between meeting in South Korea for Donald Trump and President Xi was going through. So that relieved markets because if there's no meeting whatsoever, well, high volatility, you can expect huge tariffs. Trump was talking about 500% tariffs, all that. Now, there is talk of 155% tariffs, but that's because China already pays a 55% tariff and they'd just be adding 100% more on top of that. Seems to be like a little stick as opposed to a big stick that we saw last week. So let's see what Trump says about this at a press conference earlier today.
I think China's been very respectful of us. They're paying tremendous amounts of money to us as in the form of tariffs. As you know, they're paying 55%. That's a lot of money. They never were paying anything over years and years and years. But they were like anybody else. A lot of countries took advantage of the U.S. They're not taking advantage anymore. No, China's paying 55% and a potential 155% come November 1st unless we make a deal. And I'm meeting with President Xi. We have a very good relationship. We're going to be meeting in South Korea in a couple of weeks. And we'll see what we can do. We have a very good relationship with China, but, you know, it's been probably a little bit like your relationship with China. They try and take advantage, but most countries do. I mean, I can say the European Union took advantage, but not anymore. We worked out a very fair trade deal. Japan, we worked out a very fair deal.
All right, so then he goes on for a bit about that. So markets rallied. We're almost back to all-time highs in the major equity indices, and that's with the uncertainty being taken off the table because it looks like Trump wants to be, well, I was going to say reasonable, but clearly what it seems like is that they don't want markets to go down. And if markets are going down on the tariff news, this is not supposed to be a good thing, not good for midterms, not good for sentiment, and all that sort of thing. So I can imagine markets going back up to all-time highs. Now, is there enough momentum in order to carry it through something significant? Who knows? There's the whole end-of-year liquidity jump, the Santa Claus rally, and the ideas that Kem Carson has been floating that there's going to be a rebalancing and there's going to be more collateral available for more of a run-up. We'll see. But we're not seeing that follow through in some other places in the markets, notably for Bitcoin. So let's go to this post from Plan B. He's 100 trillion USD on X. This was posted 14 hours ago, where Plan B talks about, well, let's read what he has to say. So bears think that 126,000 was the top, and Bitcoin will fall below 100,000, and 2026 will be a bear market, mainly because the 4-year cycle. In my opinion, that is a big misunderstanding. Yes, there is a 4-year halving cycle that doubles stock to flow ratio, and 6 months before until 18 months after a halving was a very profitable last 3 cycles. But 3 cycles is not enough for a reliable pattern, and it is absolutely not guaranteed that the top is again 18 months after the halving, which would be October 2025. That's today. Also, stock to flow model says nothing about tops or bottoms, only about the average price level in a halving cycle, assuming a fundamental phase transition as described in the stock to flow X article on my website in the bio. So, in my opinion, the top could very well be in 2026 or 27 or 28. Actually, I am much more interested in the average price level than the top or the bottom. What I do know is there has not been a fundamental Bitcoin phase transition yet in this cycle. Realized price, gray line, has not diverted from the 200-week moving average, black line. RSI has not been 80 plus, red, etc. Either the big jump has yet to come, or we have transitioned into a more stable price regime dominated by institutions, fund mandates. Example, 1% to 10% Bitcoin allocation, and rebalancing, sell after pump and buy after dump to keep exposures within mandate. Both scenarios are very bullish for Bitcoin. Also, in my opinion, there cannot be a big bear market without a big jump. Red RSI 80 plus and gray realized price diverting from black 200 weighted moving average. So this is interesting. This is something that's been floated around, this idea that if it's not retail participation here in Bitcoin and it is institutions, well, they have their own risk management that they have to do. They can't YOLO into positions. They're not going levered long options and 100x levered Bitcoin. So the price would be less volatile, which we have seen. We've seen less volatility in Bitcoin in this cycle. And if that maintains and it is retail adoption and the bull market is still there, we can expect a slow grind up as Bitcoin matures into a more stable asset, which makes sense. We had the last 3 cycles, each one was less volatile than the last, and it will not be surprising to see this one peter into a all-time high. But what I thought was interesting was the thread here, the first comment, where someone pointed out that this is exactly how you were sounding last cycle till the bear market hit. And Plan B comes back and says, you might have missed the 2021 December 21st message for a number of different reasons. And so he's saying, he said in December 2021 that Bitcoin had topped. Here's why Bitcoin will see another 80% crash next crypto winter, according to quant analyst Plan B. So the person comes back, Crypto Buffett comes back and says, exactly my point. I remember following you closely that year. Market topped November 10th at 67,000. It was when it became obvious you accepted the market was topped like you were doing. December 21st, Bitcoin was 48,000, almost 30% down from all-time highs. Of course, it was obvious already. We are in a bear market, and soon it will become obvious. Maybe then you will call it. And then Plan B says, yes, December 21st, 2021, Bitcoin was at 48,000, 30% down from all-time highs, and I was indeed late recognizing the end of the bull market and start of the bear. But today is different. 30% down from 126,000, all-time high would be 88,000. And like I said, we haven't seen RSI 80 plus red yet, nor realized prices divergent from 200 weighted moving average. So I think this is pretty interesting. There's a point on both sides here that you really have to go back and see what people are saying in past cycles to see if they're just repeating the same sort of thing right now and rely on the fact that people are not paying attention, or maybe they don't remember themselves. And here, Crypto Buffett was saying that when Bitcoin was down 30%, that it was obvious that the bear market had started. Now, this is false. Bitcoin regularly falls 30% or rises 30% in a bull market or bear market. These dips and bounces happen all the time. It's really when Bitcoin falls 50% and below the yearly average that we really start triggering the bear market level. But Plan B comes in and says, hey, we're not down 30% yet, and we've not gotten into any massively overbought level. There's been no hype. There's no levered longs. We're not seeing that. So where would the mass liquidations come from in order to drop the price 80% from here? That's the claim. So I thought it was pretty interesting, since Plan B is one of the notable people in the space who popularized the stock to flow model. I think he came up with it. Moving on. So in the mainstream, so this is like, now we're on Bill Maher, right? If we're going to talk about mainstream, this is as mainstream as it gets. This is he was been there for Politically Incorrect, Real Time with Bill Maher. He's been on TV for decades and decades and decades. He's I'm trying to remember the guy's name. I can't remember the old guy's name, who's Larry King. Larry King? Yeah, I think Larry King. He's the Larry King of late night TV. So Andrew Sorkin from CNBC was on, and here's a little exchange that they had about gold.
Gold prices hit records high this week. Oh, they did? Yes, they did.
Oh, and that didn't sound good.
That's not a good sign. Usually gold goes up.
It's good if you're decorating the White House.
Gold goes up when you're worried about the value of the dollar going down. That's the equation.
And what has the dollar done?
But people go to gold when they are scared, right?
Yes.
Mm-hmm.
It's so crazy. Gold. I mean, it's so antiquated.
I mean, what are you going to do with gold, right? Walk around with a bar and hit somebody over the head? No. And then we like, no.
And also, like, I mean, I think I have some gold in my portfolio. I don't actually have it in my, right? It just says, it's still something just right on.
Right, it's still digital, right? Yeah.
Right. It's still like I own gold.
Okay,
like
but are you a Bitcoiner? Because people say that's digital gold.
I understand.
I'm in the Warren Buffett camp of you'd be much happier owning, a little piece of land that you could farm because it actually produces something. Whereas if you own gold...
I have a little piece of land, and I'll tell you what I produce.
All right, I find this so fascinating, this exchange, where we have both the misconception of what gold is inside of someone's portfolio, if you're not holding physical gold, and also what Bitcoin is, that since it's not a productive asset in the way that he's describing land, that it's not as valuable as that land. And I should do a whole video just going over this, talk to Peter about this, but it's really fascinating. But the idea behind it is that the gold is going up not because retail is buying it, even though that might be the case, is that central banks are buying it. And central banks buy gold and because they want to hedge against the systemic risk within the financial system for a number of different reasons. And so gold going up is a barometer of what the powers that be think is going on. That's why it should matter. And the idea here is that he's saying, well, it's antiquated. It's like, antiquated? Well, all the central banks in the world buy and own gold. So how antiquated can it actually be? Then the idea of the productive assets such as Bitcoin just belies the understanding here that we have a financialization of our system, right? Especially in the U.S., their economy has been financialized because their main export is dollars. They went from a manufacturing base and they just haul that out because of the nature of having the world reserve currency, and they're in a financialization space where an asset such as Bitcoin that does not yield crops, let's say, is far more useful because it's a financial asset that's high performing, highly liquid, transferable across borders, is basically an upgrade and a next version of the main export of the nation. And the idea that Sorkin here is talking about land as being more valuable is makes it so that he doesn't necessarily understand why Bitcoin is more highly valued than land, which I find strange that someone who's exposed to financial markets all the time is not getting that. But hey, to each their own. But Bitcoin and gold is being talked about in the economy. So this is the equivalent of your best friend, your mother or whatever coming to you who's not interested in retail markets at all, and now it's coming up. And when it comes up there, that's usually a sign that, hey, things might be problematic. Give me 1 second here. All right, folks, thank you for your patience. So next up, we have here, oil is in contango. So if we're talking about, hey, on mainstream old school news, we're getting talk of gold and Bitcoin and problems in the financial system. Oil is another one of these canaries in the coal mine. So this comes from Javier Blas on X, who says, chart of the day, incoming oil glut in a chart. With the exception of the first 2 monthly contracts, the WTI oil curve is now completely in contango. Quite a shift from the backwardation of 3 months ago. So you'll see here that the backwardation that we saw 3 months ago and 1 year ago has the price of oil now, the short-term price of oil is higher than the long-term price of oil. which makes sense. If you are promising to buy oil further out, you're going to get a discount because you're providing reliability, guarantee that you're going to be buying that asset later on. So you get a discount. And as that oil contract comes back in time, comes towards the present, the price increases. If we have it the other way, as we see it here in white, where the current price is lower than the future price, that means there's too much oil right now. And that has to do with all kinds of number of factors. And what it usually lends to is this idea that the economy is suffering, manufacturing is suffering, industrial process is suffering, travel is suffering, travel is suffering all across the curve. Oil is one of those things that exist all across the markets. So if that is lower price now than it was, that it will be in the future, that means people are seeing this. This is a recessionary signal. And it lends to the idea that gold has been falling pretty significantly. All right. 1 second here. All right. So finally, nope, not finally. So here I wanted to talk about more stress within the system, which comes from one of my favorite YouTubers and posters, Jeffrey P. Snyder from Eurodol University, who tells us about what's going on behind the scenes here with the Fed. So, is escalating money market deflation pushing the Fed to the cusp of the next QE? There are a number of reasons to think that that's the case, starting with some very close comparisons to 2019 when repo markets problems forced the FOMC to try to deal with them by raising the level of bank reserves. Bank reserves are Bank reserves are irrelevant, but they are the only tool the Fed has other than rate cuts. We see very well how the rate cutting is working out, predictably having zero impact. The Fed merely following the market. But now we've got, this is the bond market he's talking about, but now we've got credit issues popping up. Diamonds, this is Jamie Dimon's cockroaches that he's been talking about, and genuine Eurodollar tightening, not just in repo. None of them having anything to do with QT and the Fed's reserves. That's what you're going to hear, however, from everywhere. And it's another close parallel to September 2019. That's the excuse everyone still uses to this day, even though the Fed at the time recognized it wasn't reserves. Officials even said so before they realized they had to get their story straight. If the FOMC judges the repo mess to be more of a threat than non-existent tariff inflation, then they would believe their only course of action would be to raise the level of bank reserves, so reversing quantitative tightening, but like 2019, refusing to call it QE. Doesn't matter. What does is how that would be yet another piece of confirmation, along with WTI contango, potentially super contango, of escalation across money like macro. Definitely go check out more of his videos in order to get more information on that. But it's speaking towards this yet another domino fallen, that there's a tightening within the system, or a drying up of liquidity in the system that can be very problematic for risk assets. And finally, the small clip is from President J.D. Vance, who is coming out, and clearly they want Bitcoin up, they want crypto up, and look what he has to say.
The consistent fear that I hear is that there's still this perception that digital assets are not welcome in the mainstream economy. And let me promise you that our effort to change the policy is purely about changing that. We want our fellow Americans to know that crypto and digital assets, and particularly Bitcoin, are part of the mainstream economy and are here to stay.
All right. Get that crypto up. They want those numbers up. So let's see. The administration wants crypto to be higher. Stock markets are up, but Bitcoin is down. And Bitcoin is just one of those other things that can't lie in the same way that the regular markets can, because it's correlated highly with liquidity. And if liquidity is down, Bitcoin is down. So does that mean we'll see the NASDAQ and S&P at lows? Maybe, probably. That's what I'm thinking. All right, that's it for today's Daily Bread. We'll be back tomorrow with another episode. Please like and subscribe, and we'll see you tomorrow.